Welcome to your Mortgage Insider Update. I hope everyone enjoyed a wonderful Thanksgiving holiday weekend, was able to travel safe. We are going to close out with a strong month of November in the interest rate world. So after a horrible month of October, November has shaped up to be a much better relief in interest rates. So we're going to take a look at that right now. As we kick off the week, we have interest rates down with 10-year Treasuries 4 basis points lower at 4.43%. We take a look. That gives us a pause here at this Fibonacci retracement level. It has actually hung here since November 17th. We're hovering right above this 100-day moving average. It's going to take some major news events to get us below. This is, looking into the future a little bit. But we are going to have reports coming out with the personal consumption expenditure this week, unemployment reports for the month of November as we do close this month out. It's possible that we could have a 4% or higher unemployment rate. And 4%, if you remember, 3.9% was a big number. It got 0.5% higher than the low of 3.4%, lowest unemployment rate we'd had in as almost as long as they've been keeping track. But if they go backwards in time and look at every prior recession, one thing that happens in a recession is interest rates come way, way down. And we are potentially looking at the unemployment rate coming into the holiday season, which is a very unseasonable time to lay a lot of people off. If we see a number in the 4% range, we could see 10-year Treasuries come way back down. That would bring us back to like late August, not the most unbelievable interest rate market that there ever was, but gosh, that's a way heck of a lot better than we saw back in the middle of October. As we take a look at mortgage-backed securities, now mortgage-backed securities are traded on the improvement of price. So as the higher price to the investor, the lower the interest rate to the consumer. We see the mortgage-backed security bouncing back up today. This is coming off of highs as far as the prices go back on November 22nd, since before Thanksgiving. So we are above the 100-day moving average, pushing up closer to, given some positive news, this could breach us even higher. If we go back just to mid-September or early September, late August, those are the levels that we briefly touched on back then. Could we see, with unemployment rates increasing, with inflation reports coming out before the next Federal Reserve meeting, which happens in the middle of December, we have first PCE, personal consumption expenditure, coming out this week, but in 2 weeks we'll have Consumer Price Index right in the middle of the Fed meeting. So Consumer Price Index has been coming down, so has PCE. So as those better numbers come out, we could see the rally, and this is where the prices can rally, which brings the interest rates down to the consumer. So could that happen by the end of the year? We shall see. So we don't want to count our chickens before they hatch, but we are looking forward to data points coming out by the end of the year that could improve interest rates, or could it vastly improve the outlook of interest rates, which is a lot of this is really based on what do the traders think is going to happen in the future. They're the ones buying the mortgage-backed securities. The Federal Reserve has been depleting their purchase level, or their runoff, I should say. They're not repurchasing mortgage-backed securities and treasuries as they run off their balance sheet. Could some of this data change their tone and change the way that they go about it? One thing that could help overall with the economy to pull us out of what could be the beginning of a recession would be to stop running off the balance sheet. So that would just mean to maintain the same level. It's still at like $8 trillion that the Federal Reserve owns in both mortgage-backed securities and treasury bonds. We shall see, as the beginning of next year is just around the corner. Have a great day.